Should investors stick with Apple and Nvidia or seek value in smaller names? Let's bring in Brian Jacobsen, chief economist with Annex Wealth Management. Brian, good to see you. I'm happy to see you're smiling there. That means you must be happy with the way the markets are performing so far this year.
Yeah, so far so good. January and February have been pretty positive, so let's hope that this can continue for a while. Warren Buffett's warning to investors, I do believe, needs to be heeded, of course. You can't argue with his success, but I think that really what it highlights is one of the problems with size. In order to move the needle on return of investment for a company of that size, he has to find bigger deals. And so we actually think here at Annex on our investment committee that a lot more opportunities could be transformational in the small and mid-cap space instead, where they don't have to, worry about $136 to $37 billion in cash on their balance sheets.
Right. Well, you've just touched on something that I wanted to ask you a little more about. Do you think Buffett's, quote, warning here was more about how difficult it is for him and the people at Berkshire to find companies of a scale that are value plays, because that's the way he likes to find hidden value, but are large enough to move that big battleship called Berkshire? Or was he talking more broadly about the dearth of value in the market?
Yeah, I think you're right as far as the first interpretation that it's really a Berkshire-specific and maybe large-cap-specific worry that he has. As far as if you want to go out and if you're Berkshire, buy a big enough company, the valuations there might not be as attractive as if it was in a smaller company. But is it really worth his time? These might be more the crumbs from the table, but you can build a pretty good feast from the crumbs from Warren Buffett's table, that's for sure.
Brian, when you're talking about valuation, the first thing I'm thinking of is what Tyler discussed in the intro. Names like NVIDIA, for instance. It seems like it's only going one way, and that is up. That being said, if you're not in it, it may be a little intimidating, perhaps, to jump in now. When you're looking at valuations and concentrate in success in some of these magnificent seven or however many number you want to categorize them as, I mean, is that a no-brainer? Is that where you just have to be in this market until we have real substance that we're seeing things broaden out?
Yeah, we think that we are going to see things broadened out if you look at the actual performance of, say, like industrials and even materials over the last few weeks. Small caps have occasionally performed pretty well, and that we have seen early signs of some broadening and maybe a little bit of this top heaviness of the markets beginning to turn. But then all of a sudden you get the shock from NVIDIA where, their revenues are up more than 200% year on year. And so I think that's actually kind of an important thing to note, is that the stock price has gone up quite a bit, but as have the fundamentals. And really until we see the fundamental weakness, I'm not too worried about the valuations that we're seeing with some of those names, but do keep in mind, risk is fun and games until it actually results in down markets instead of these up moves that you've seen.
Sure. If you're an investor that's still looking at elevated rates, knowing we're not exactly sure what the Fed is going to do and when, but as of right now, they're sort of on hold, and we know that rates are elevated. Should you be looking for maybe a play that's a little less risky, putting your money in some kind of high yield account that is not junk? You say not all high yield is junk.
That's correct. Yeah. So we work with a number of high yield managers where they actually have more of a focus on looking at the higher quality high yield bonds, sometimes called junk bonds if you want to use a pejorative for them. But with some of them, it can actually be fairly high quality if you're looking at the EBITDA, so the revenue generation relative to what they need to service. Some of them have been able to term out their debt. And so it's really dangerous, we think, in this market to just take that broad brush scattershot approach to investing in an asset class. There are lots of these different pockets of opportunity. So it might be high quality, high yield. It might also be some of the more profitable, lower leverage, small cap and mid cap names that are out there.